Hello there, welcome back. You're watching News Now with me, Snehisha on ET Now. We're just getting the first whiff of the GDP data coming in. India sees FY25 GDP growth at 6.4% year on year. The estimate was 6.4%. Remember, the RBI's estimate was 6.6%, so that's a little bit of a mismatch coming in these two estimates. The first advanced estimate for the GDP product is out. Real GDP has been estimated to grow by 6.4% as compared to the growth rate of 8.2% in the provisional estimate of GDP of FY23-24. Nominal GDP has witnessed a growth rate of 9.7% in FY24-25 over the growth rate of 9.6% in the previous financial year. Let's also shed some light on real GDP and the data that we're seeing coming in. Real GVA has grown by 6.4% in FY24-25 over the growth rate of 7.2%. So that's a slight bit of a dip coming in over there. The nominal GVA has shown a growth rate of 9.3% as compared to 8.5% in the previous fiscal. The real GVA of the construction sector, you have financial, real estate, professional services, all of these numbers are out, and we'll be taking you through all of these numbers as well. But on that note, let's go across and also connect with some of our guests who we have on the show today. And we have Pranab Sen, the former member of Planning Commission, joining us on the show. Joining him is also Mr. D.K. Joshi, the chief economist at CRISIL, and we have Aditi Nair, the chief economist at ICRA. Thank you so much, all of you, ladies and gentlemen, for joining us on the show today. First up, Aditi, let me come to you for your first take on what these numbers mean for the economy. Tell us what you are making. What's your initial reaction right off the bat for these GDP numbers today?
Thank you. Well, our estimate for the full year is about 6.5%, both for the GDP and the GVA. And my experience as an economist tells me that when growth is lower in the first half and expected to pick up in the second half, the advanced estimates sometimes tend to underestimate the full year growth because they're quite heavily influenced by the data that we already have. So I'm not surprised that there is this slight difference between our full year estimate and what the advanced estimate has put out today. I'm not terribly concerned about it having come in lower than our estimate either. Having said that, there is a lot of global uncertainty that we have to contend with going forward. And that is something that we have to keep in mind when we look at how to project the estimates for next year as well, which is very important now that we're pretty much in budget season, and we're looking at a 6.5% kind of a GDP growth for next year as well.
6.5% for next year as well. That's the view coming in. Mr. Joshi, coming to you now. In your view, does the latest GDP data suggest a sustainable growth trajectory, or are there signs of potential volatility in the long term? Do you believe this number is slightly on the cautious side?
No, I think, the growth was expected to come down in any case, in 24-25, because you had somewhat lower fiscal stimulus, and also on top of that, monetary tightening also was playing out. So that was bound to bring the economy from above trend rate of growth last year to close to trend. Now, what happened was that in the second quarter, GDP slid much faster than expected. And one of the reasons was slower government infrastructure spending, or capital spending, so to say. Now, what this estimate suggests is that, one, that the rest of the year is unlikely to make up for the investments that were not done as scheduled earlier in the second quarter. So I think I'm not too worried about this growth right now. And my sense is, we haven't seen the consumption data, but my sense is consumption would have done definitely better than last year over a lower base. For next year, I think we do expect the economy at 6.7%. And the drivers of growth will be, of course, we make an assumption of normal monsoons. But in addition to that, I think we also factor in some monetary easing, not too much of it. And oil prices, I think, are expected to remain soft in the 70 to 75 range. So I think these factors will be supportive. And on top of that, we do not expect the government to take the pedal off the capital spending. And I think so the budget will maintain its focus on infrastructure spending. Under those assumptions, GDP growth is expected at 6.7% next year.
That first take coming in, Mr. Joshi. Mr. Sen, coming to you now, we'll talk about more of how this impacts the budget. But before that, I also want to get your sense on how this is going to affect our central bank action now, because these numbers, the 6.4% estimate is the lowest in 4 years. How do you think the central bank will react to this latest GDP data in terms of interest rates, monetary policy, and will this data influence their stance on inflation going ahead as well?
It shouldn't actually.
Okay.
Because as far as monetary policy is concerned, they should be looking forward. So what is much more important is what this number indicates about the future. Will the RBI dramatically revise its estimates? So that's what will be the driver. And I don't think this particular estimate will change their perspective in any dramatic manner. So I wouldn't worry too much about the RBI overreacting to this particular data footprint. And the RBI is also aware of the fact that the advance estimates that we get are really just partial data for the third quarter, and with almost nothing in the fourth quarter at all. So the sort of margin of error that you have in advanced estimates is quite large. And I think RBI recognizes that. But what is, I think, a little more heartening is that this data footprint seems to suggest that we are coming to what should be the trend. If it does, the RBI will go with somewhere around a 6.5, 6.6 growth, longer term growth projection, and will act accordingly.
You coming in, Aditi, just want to get your sense. The mismatch between the provisional estimates and the figure that we are now seeing is quite significant. And also now with the government expecting 6.4% growth, do you think any specific sectors will be in focus during the budget? Could you first explain us why such a big mismatch? We understand that there's been a slowdown in terms of consumption, in terms of other parts of the economy as well. But could you explain to us why such a big mismatch, and also which sectors could you think, or do you think will be in focus during the budget now that we have revised our estimates so drastically?
Seen the sectoral data, so it's a little difficult to comment.
Have some light coming in on the sectoral data, Mr. Sen. You have agricultural growth that's seen at 3.8% versus 1.4%. That's looking good right now. Mining sector, that's the one that is seen a quite bit of a downfall, coming in at 2.9% versus 7.1% year over year. Manufacturing also seen a big drop at 5.3 compared to almost 10. Construction seeing a slight bit of a mellow drop at 8.6 compared to 9.9. Services have seen a roughly 4 bips cut coming in, 7.2 versus 7.6. Industry growth is being seen at 6.2 versus 9.5. I understand these are a lot of numbers to comprehend right now, but other than agricultural sector, I think mining, manufacturing, construction, all of these sectors have seen deep cuts on a year-on-year basis. What is the course of improvement here going ahead?
Mining is concerned, I wouldn't worry too much.
Okay.
Mining is a very seasonal activity. So I won't worry dramatically about it. It's really manufacturing would be the source of concern. And the real question there is whether or not the slowdown in manufacturing is happening because of supply side constraints or demand side constraints. If it's a supply side constraint, then one could see steps being taken in the budget to try and correct some of these problems that are being faced, if at all. But if it's a demand side problem, then the attitude of the budget would have to be dramatically different. And so it's difficult to say until we have been able to analyze what the source of the slowdown is.
Okay, Aditi, coming to you, want to get your view now. What do you think is going to be the government's focus, particularly if you could give us a sectoral outlook when it comes to the budget? Do you think we could see some upward revision to the capex coming in, given that we do need a fillip or a push to the consumption side of the economy? We need a push on the demand side. Do you think we can expect a higher estimate on the capex front this time?
So our sense is that for FY25, we're going to end up with quite a large miss on the capital expenditure as compared to the revised budget estimate, which we got in July. And I would imagine that looking at where the numbers were till November, it's going to be difficult to even get to 10 trillion now as far as the FY25 capex is concerned. For FY26, possibly, our early workings are suggesting that we can work with overall capex target of around 11 trillion. So very similar to the budget estimate for this year. And on the lower actual outcome for FY25, that should end up giving us a pretty good growth. And that is something that will then end up pushing the overall GDP growth next year. But what will be really key is to get the government capex kicked off right away and to really start seeing the monthly numbers coming in quite healthy all the way from April onwards, because we do tend to get the seasonal lull in capex during the monsoon months. This year has been particularly nuanced. We had low, very muted capex in Q1 because the elections were on at that time. And then we ended up with very heavy rains in the monsoon months, particularly in Q2. So again, that ended up being a very weak quarter seasonally for capex. And then going into Diwali and post Diwali, we're just not seeing those kind of capex numbers that we would have hoped to. And while there could still be a good amount of back-ended push between December and March, we're still going to end up with a large miss. That's the fear that we have.
Large miss on the already existing capex target that we've set, and amid a situation like that, we're already seeing some slowdown on the demand front. So this is not sounding very optimistic going ahead. Mr. D.K. Joshi, what are you making of this development? And also, we already seen growth in the second quarter was weaker. The first half of FY25 growth also roughly stands around 6%. According to you, which are going to be the key segments to bring back growth and potentially the sectors that could be under a lot more focused compared to the others during the budget announcements?
Well, I think my sense is manufacturing will be the focus, and the PLI scheme, which was the first leg of the PLI scheme, essentially focused on assemblies type operations, I think, for mobiles, etc. Now I think we'll slowly move towards more value added part of manufacturing. And that is also more capital intensive if that plays out. So that's one thing that I expect. And second, I think the focus will also be on general investment revival in the economy, because investment revival still it depends on the government investments. I think we saw what happened when government was not able to spend as planned on capital side. So my sense is that they will retain their focus in the next coming year on the capital spending, and I think that is also important from the point of view of bridging the infrastructure gap we have. And if we want to focus on manufacturing, infrastructure becomes very, very critical. So I think these two areas I do see as focus, and apart from that, I think we could see some action on the front of food inflation management, which could be, I think, making crops more resilient, trying to design something long-termish for ensuring a lower food inflation going ahead. I think those kind of steps could also be there.
Sen, also want to understand this kind of discrepancy that we're seeing in the private consumption versus the public consumption number, because that figure is quite significant. Amid a discrepancy like this, a gap like this between private and public, do you think the budget this year could focus a lot more on subsidies, on freebies, so to say? Do you think the budget this time could be a sort of a people pleaser budget or a sector pleaser budget, if you could put it that way?
I would hope not. I mean, the fact is that when we have an election coming up, then you have people pleaser budgets. But, elections are just over. We've got a government in place. It has 5 years to go. this is the time to take hard decisions. And here the question then is that how does one do it? We know that consumption is weak, but would giving more transfers actually make the situation any better? In this situation, I suspect not, because the kind of demand that would be generated by what are called the freebie system is not the kind of demand you really need at the moment. So I think the government would be better advised to continue with its capex push.
Thanks for that view, Mr. Sen. Mr. Joshi, coming back to you. Now, we have seen some pressure coming in on the rupee recently. The rupee depreciation is expected to put some more pressure on inflation. How do you think the government will create a balancing act between also focusing on growth, at the same time also fending away macro shocks? How do you think that balance can be achieved?
Is concerned, I think the problem is food, because the exchange rate weakening, I think some of it will get offset by lower crude prices, etc., and lower input costs, because I think the China is likely to have excess capacity, and I think we'll see further deflationary tendency there. So the cost of inputs, while the exchange rate might be weaker, but the cost of inputs will be lower. So I'm not too worried about that right now. And on top of that, I think weaker exchange rate will also promote exports. So it's not such a bad thing that rupee has been depreciating of late after a reasonably stable run for 2 to 3 years. So I think having said that, the inflation management will have to worry more about what happens on the climate front, what happens on the food inflation front. I think for that we need to have more strategic measures for long-term to ensure that in the long term the food inflation remains under control, particularly for the perishable categories. I think that part will get more attention.
Okay, Aditi, also give us a sense of the trade-related risks that we are seeing persisting in the current market, where you have dollar that's strengthening. Tariff hikes are also in the talks when it comes to what Trump may or may not do when he regains the reins of the US government. What are some of the key risks, according to you, to the GDP estimates for India? Now, these numbers seem to be quite reasonable, but is there anything that you think could hamper this target and maybe lead to us not being able to achieve this target?
See, the sense I have is that when we look at the medium-term growth potential for the Indian economy, it is around 6.5 to 7%, and the main drivers are going to be domestic in nature. As we go forward, we're not looking at merchandise exports necessarily being a very large driver of growth given the global environment and given the kind of uncertainty which is there right now, as well as protectionism which is coming back in many geographies. Services exports have been doing quite well. I think that is something that will continue. Possibly the rate of growth is going to come down on a growing base. But we do expect that services exports in terms of the rate of growth is going to be a bigger driver than merchandise exports. And that is something that we're generally building into our medium-term projections. And this is one of the reasons why we don't think that a 7.5 to 8% GDP growth is a plausible potential rate over the medium term. We think it is going to be closer to 6.5 to 7%. So having said that, both FY25 and FY26 seem to be right around that potential GDP growth range. So these are not terrible years. Yes, it's a slowdown as compared to last year, but that was to be expected. We did have the temporary impact of the elections in Q1. We had another temporary impact of very heavy rainfall in Q2. And despite that, if you're going to end up with a 6.5% growth or thereabout 6.4% growth, right at the lower end of both the eco surveys forecast for this year and where we think the potential GDP growth for the economy is, it's not something to be terribly concerned about. There is a lot of unevenness in the economy, and that is something that policymakers possibly need to think through, how to be able to address those parts of the economy that are experiencing more of stress, and how we can kind of really pull them up and pull up the growth rates for those parts of the economy in line with what is growing faster.
Okay, thanks for that view. Mr. Sen, in your view, does the latest GDP data suggest a sustainable growth trajectory going ahead? Are there any signs of potential volatility in the long term? Now, Aditi did share her targets with us, 6.5% and 7% GDP growth for FY25 and 26. What's on your radar? What kind of numbers are you penciling in for next year?
Well, I'm penciling in 6 to 6.5%.
Okay.
So Aditi and I agree on the 6.5 bit, but she is optimistic and I'm a little more pessimistic. Will there be volatility? Of course there will. The global economy is still not set, and if we try to go purely on the strength of our domestic demand and domestic conditions, we should not expect to grow at anything very much more than 6% as of now.
Cautionary stance coming in from Mr. Sen. Mr. Joshi, also break down this number for us now that this potential GDP number that we've seen, GDP number, pardon me. What does this mean for the common man at the lowest strata when these numbers trickle down? Because on one hand, you have inflation that seems to be sticky, food inflation continues to be high, and with a growth target at 6.6% like we've seen right now, 6.4%, pardon me. What is the meaning of all of this when it comes to an individual spender or the common man? How does this pan out for the common man, his budget and his wallet?
Well, I think the data released today doesn't tell you about how the GDP is distributed within the economy. I think it's only giving you an aggregate of how the overall economy is growing. For that, you need consumption expenditure surveys, and you need to drill down. I think from the macro data that we have right now, I think one thing is very clear, that the food inflation is high, and food has a very large weight in the consumption basket of individuals, particularly of the poor. So it hits the poor more than it hits the upper income categories, because poor people have higher proportion of food in their consumption basket. So higher food inflation has been hitting poorer people more, but I think some of that gets offset by the free food program that government has launched, and I think that is covering quite a few number of households. So on the cereal front, I think they have a cushion, but on the vegetable front, I think which have seen very high inflation, they don't have. So I think how the distribution of growth is, how the growth is distributed across income categories. I think for that, this data doesn't tell you much about that.
Okay, and Aditi, coming back to you, just on a parting note, how do you think the markets are going to react to this number tomorrow?
So I just want to clarify first, my growth forecast for FY26 is 6.5%, not 7%. 6.5 to 7% is the medium term potential GDP growth range that we're seeing right now. I think today's advanced estimate is just around where the market was expecting it. So I'm not really anticipating there to be much of a reaction, to be quite honest.
Okay, well, so let's see how the markets are going to pan out. We have seen some kind of volatility being penciled in on the markets. That's what we're seeing built up. But on that note, well, thank you so much, all three of you, for joining us, Mr. Sen, Mr. Joshi, as well as Ms. Nair. It's been a pleasure chatting with you, and thank you so much for joining us on ET Now. With that, it's a wrap on this edition of News Now. Thank you so much for watching.